Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News, episode number 221 for April 22nd, 2019. Sorry, I'm getting some feedback from something. If you have not had a chance to take a look at today's report, you should be seeing it on your screen while I'm talking now. Or you can go to TimingResearch.com/reports, and you can get access to either the web or PDF version there. We are broadcasting live on YouTube at 1 p.m. Eastern Time, but you can also get the audio-only podcast version on iTunes, Spotify, Stitcher, or wherever else you listen to podcasts. My name is David Kosmeter. I'm the creator of Timing Research, and I have Michael Filighera here to moderate today. So I'm going to go ahead and turn it over to Michael.
And thank you very much, David, and good afternoon, everybody on the East Coast. Good morning on the West Coast. And I hope everybody had a wonderful holiday weekend. We are back on Monday, and it seems that many people have, or many traders have taken the day off. We have a very slow trading market as far as that's concerned, but still, I think we have some very interesting things to go over today. And I have Jim Kenney from The Option Professor with me today. And I am going to start by letting Jim introduce himself and tell us a little bit about what he does.
Okay, thanks a lot, Michael. The Option Professor obviously is education-oriented, trying to go over the uses and the risks of option trading and using the different strategies that are available. Not any strategy is right for every single person, so investigating all the different strategies and finding out what might be right for you is not a bad thing to do. And the strategies are generically about creating cash flow, or they are about limited risk speculation, or they are about hedging, which means you're going to have a position that would do something toward your existing position, that if an adverse move occurred, you'd have an offsetting position that could either reduce or hedge the movement. And I am the content provider for Option Professor and have been for decades. And that's what I do, and that's what we're doing.
Thank you very much. And again, I'm Michael Filighera. I'm with LogicalSignals.com, and that is my proprietary website in terms that I am the chief cook and bottle washer. At the moment, I continue to remain in a reconstructive phase in terms of what direction I'm going to be taking things. Currently, I am a day trader, but I have over 40 years experience in the markets. I was a options market maker on the Pacific here in San Francisco, but also in London on the London traded options, and in Amsterdam on the European Options Exchange. And then I returned here to San Francisco. I jumped into day trading when the volatility was just really getting pounded and pounded and pounded. There wasn't very much to do option-wise when you're a market maker looking to take advantage of premium. In any case, I am now basically a day trader, and some of the things that we're working on is I'm setting up a new website, going to provide more content in terms of just daily commentary about what I believe is going on in the futures markets and how we're trading them and et cetera in that respect. But also we're working on a auto trader, and what we're realizing we need to do in that auto trader is to have several different versions, for lack of a better word, that will be able to trade a choppy market, a trending market, traded within a period of time that historically is when a market's going to make a move. Whether that be the Dow, the NASDAQ, crude, gold, doesn't make any difference. So you can go back and study pattern and study price ranges and then time ranges and really figure what's going to be the most optimal time to be in there trading. And it doesn't make any difference whether you're long or short. It's just to be in there trading and trading the move that's occurring. So let's jump right into what we're here to do today. And that is that the first question that we get asked is, which direction do you think the S&P 500 index will move from this coming Monday's opening, so that's today's opening, to Friday's close? So we're going to determine whether we think it's going to go higher or lower. And then at the same time, we will also we will rate our confidence in that answer by estimating the probability that we believe that what we're saying will happen. And I'm going to start with Jim.
Okay, well, the setup continues that they are buying the dips. There's a lot of risk in the market both ways this week because of, I think, 1/3 of all the companies in the S&P are announcing their earnings this week. So the market is in a range, and but the moving averages are up. The VIX is in an area where it's bullish, and they've tried to hit this thing a number of times, and it keeps coming back. So although I would not count on it rising, if I had to make a vote here, the probabilities are for rising, and I would go 55% probability because of all the technicals and fundamentals are definitely in a rising mode, and the news has not been problematic. So if those, obviously with all that in the backdrop, you'd have to respect the rise, but 55 against as a probability means that you can build a nice case for the other side very easily as well.
Very good. I am also saying higher for this week, and including into what Jim has already stated, that we've got all the big majors pretty much are reporting their earnings this week, and they're very hotly debated and again anticipated just because we're sitting up at towards that record highs. And in the S&P last week, I did call lower, and just based on that, I believe the market needed to just do a small pullback, and that's exactly pretty much what it did. And that just set the stage for, I believe, for the market to go up, to move higher, and to new all-time highs. And I think then that completes a very much larger move. But nonetheless, I do think that we should see the market eventually move to new all-time heights. Now, whether it manages to do that this week, yet to be seen. But I am going to agree with Jim and the forecast respondents in saying that the market moves higher. And I am going to go a little bit higher on my probability and say 60 to 65% probability that the market will do that. If we had to base it on today and that the market popped higher and after being lower and now is just kind of sitting on that cusp of a couple of ticks were up on the day, a couple of ticks were lower on the day. And so we'll see what happens. So today may indeed end up being down, but as Jim has already stated, I really don't think that it's going to end up lower this week unless these earnings reports come out extremely negative. Our next question, or let me just, I'll just go in and say that for this week, the majority of the respondents did say higher, 61.5% are higher, 38.5% are lower, and that and for all the respondents, they were rating their confidence at about right where I am, 63.3% or 63.4% for higher, 63% for lower. So you can see it's almost like exactly what the market is doing today. It's not really down, it's not really up. So it's kind of sitting right there in the middle. And we're just going to have to wait and see. Before we move on to some other things that we do want to talk about today, I just going to go back to Jim and then myself. So for our answers to question number one, we would like to just discuss a few specific reasons we believe that the S&P 500 will be heading higher. In our case, since we both are saying higher. And of course, we've already said all the earnings reports, but let's see if we can add anything else. And Jim, I'll turn it back over to you.
All right. Well, the reality is that the market's in the middle of a trading range the last couple of weeks of 29.15 and 28.75. So that's reality. So obviously predicting which way it's going to break is a rough racket. So what I would be more looking for is a strategy that might either A, benefit from either direction, or wait for a breakout and then go with it. My base case when it was down at 2350 was a snapback rally to the 200-day average of 2750, which is what it did. And then basically when it broke through the 2750 200-day, again, the Fibonacci, the Elliott waivers gave a target of retesting the 2940 and then rolling
Mhm.
over. Now, I'm a believer that we are either going to go up to that 2940 or we're going to fail in this 2920 area. But I think somewhere between here and 2950, 50 points one way or the other, the market's going to run out of some steam.
Mhm.
And if in fact that happens, then the wave two to the downside that we haven't really seen may very well occur. So again, I'm looking at the transports having some resistance up at 11,000, and of course their all-time high is 11.5. I'm looking at the Russell, which has failed to really rally for the last week or so, and it is today the Russell is down another 6, and the Russell has been a little bit of a leader. So
Mhm.
I'm getting the warning signals out of the Russell. I'm
Mhm.
getting the Elliott waivers say that this neighborhood is a neighborhood for selling. I'm getting the VIX at the 12 reading, which is
Mhm.
obviously in a overbought condition. And I'm at a position where the transports are stalling out. Boeing's now rolling over. So
Mhm.
again, if we take out the 2890 and the 2875, that could be the indicator price wise that we are going to roll to the downside. There's always that risk of a melt up because, as Larry Fink was saying from BlackRock, he sees his book, and his book is trillions of dollars, having a little bit of an under investment situation here. And clearly, Trump and these guys want the market to constantly go higher. So any strategy that I would do, in my opinion, in my view, would have some type of a hedge on the upside, maybe a limited risk call or something like that to hedge any kind of selling up here. But in this neighborhood, the strategies on options that I'd be looking at would be the long strangle, because then you got
Mhm.
two sides of the market handled
Mhm.
and it's
Mhm.
limited risk. I would look at the covered call writing if I was interested in getting some cash flow, because with this kind of rally we've seen, the calls are probably really reasonable.
Mhm.
I would look at the collar where you sell an out of the money call and you buy a put to protect my positions. And again, with all of this announcing of earnings, volatility may very well pick up. But we've come from 2350 to 2900 pretty much in a
Mhm.
straight line,
Mhm.
and that means all the short covering has been done, and all the spec buying has been done, and all the people who wanted to load up in Q1 has been done. And now we're facing May, June, and July, where without new news, we could have some difficulty getting through the neighborhood of 2950. So if you're at 2912 or 2905 and you don't think it might go very much past 2950, if you're a farmer, you got to start planting for the next crop, and the next crop here could be the pullback.
Very well stated. In fact, you've included everything I was going to talk about, but that's great. That works very, very well. One question I would ask you before I give my bit here is, would you look at the further out? So right now, I believe in the VIX, all you can do is go out to September. Would you start buying some calls out in September in
No,
the VIX?
I mean, like I say, I mean, since I'm a believer here, my view, my opinion is that between 2,900 and 3,000 is going to be it. I don't think there'll be a melt up. Of course, there could be. That's why you'd like to either hedge or have a stop loss or have some hedge with a different kind of a position in case there is, because it could be a melt up if these earnings come out great. Obviously, the people are thinking the second half of the year is going to be fantastic. And if there's such underinvestment in there that the money's going to flow in, well, if the money flows in, the guy who's on the other side of the trade, the seller, he'll raise the offer until he
Right.
sees the volume dry out. So could there be a melt up? There could be, but I think the more probable situation may very well be that the 2950 ballpark area. could be a resistance zone. But
Right.
yeah, I would not be buying long-term calls up here with the VIX at 12 and the all-time high right here, and something that's already gone up 600 points almost.
Right. I was talking in terms of buying the VIX, buy the VIX calls.
Oh,
So
I don't do the VIX. I never played the VIX as far as trying to play the
oh,
VIX.
okay. All right.
The VIX to me is really just another piece of the puzzle. I would not. I'm not a proponent of trading the VIX.
Got it. Not a problem. Okay. So
Using the VIX, yes. Trading the VIX, not so much.
okay. Perfect. I like that. Again, my reasons for considering and still feeling that the market still has more upside room, and it's just I'm basically going to be piggybacking on what Jim has already included, but I can speak more towards the Elliott wave count. And currently, because we did come down, I was not looking for a big pullback last week, and we didn't really get a big pullback. But the fact that the market is unable to really kind of move into positive territory today in terms of like picking up the rally again suggests that we still might have one more little down leg that'll take us below last week's low, which in turn will produce all of us that are saying higher for this week, to be in the negative column. But in any case, I still think even if we dipped off of these levels, like 2908 to 2910, we might dip back down to that 2875 level and then produce our rallies. Again, what's going to really collar that or hold that are these initial earnings reports that we are waiting for this week. I mean, we do have Apple, we have Amazon, we have, I believe, Boeing. One of the things that the market was doing today, they have run out and they're now jumping back into FANG, which is Facebook, Amazon, Netflix, and Google. Google was down, now up. Netflix is up 11. Amazon's up 21 after being down this morning. So that continues to hold things at bay. And I believe a lot, of course, is going to come with what really will happen with those Apple earnings, because, of course, there's the anticipation that they're going to continue to blow out the doors, and they're so wonderful, has pushed the stock from below 200 to now back above 200, and now heading towards that all-time high. What I think, again, just on this small time frame, and I use the daily to the hourly chart, we must leave open the possibility that we will drop down to 2875. Again, in the terms of what we're talking about here, that will produce a lower close by Friday. Or it does it intra-week and then takes off. So we have to allow for both. I agree with all the different strategies that Jim has just discussed. One that I like and that I will talk about is the VIX options, the volatility index options. And Jim was correct in that it's now in the 12 handle, in the upper 3/4, 7/8 of that, of the 12 handle, so that, trading at 12. And right now, front month is April. And the furthest out that it goes is October. So if I were to be looking at the October options, remember, if the market sinks, the VIX goes up. The VIX gains in value. It's a volatility. We would expect volatility to begin to increase. So if indeed we're going to get up to a top and then begin to tumble, even if we get up towards that 2940 area to 2950 area, which would produce new all-time highs, you're going to likely start to see volatility start ticking up, because we just have too many traders who are saying that level, that's like, how are we going to support that? And again, what could push it up there is exactly what Jim said. You got BlackRock, the head of the BlackRock funds, coming out and saying, we might look a little bit under invested in some particular sectors. And we're going to flip around when I'm done here. We're going to flip around and start to talk maybe about some of those sectors. And I think Jim is going to be the excellent person to begin to we're going to piece this together. We're going to give it our best shot. But in any case, my plan or my trade would be going out to the October options. Because remember, the further out you go volatility wise, they're not going to be pumping up the prices so much because there's just too much time. So October is trading at about 54 volatility, whereas May and April's trading at 121, and May is trading at 110. So you can see that they'll start to move those as it gets closer towards that expiration. Going out into October, I likely would start looking at the October 12 calls, 13 calls, 14 calls, 15 calls. I mean, you can go all the way out as far as you want, and you're going to get, of course, a lower price, the higher the strike that you're trying to get. And what I would do against that is I would turn around and I would sell either an April or a May call. So you're basically just doing a vertical spread, but not necessarily in the same month. So it's a calendar spread. And
yeah, Michael, I think as far as that VIX is concerned, my opinion on the VIX is that last Wednesday when we went to 1175 was a low point, and that the VIX has a much better probability of moving away from 1175 higher than it does taking out 1175. So if the premise of a rising VIX off of last Wednesday's spike low, I think is more reasonable than thinking that spike low will be taken out. The BlackRock guy was saying that he believed investors were generally underinvested because he's looking at the levels of cash.
Oh, I got you. Okay.
But again, investors, who are older, may, have higher levels of cash because they don't want to lose their money in the market if this 2,900, 3,000 is the end of the game. And they're above 55 years old, they may not be interested in getting involved in a volatile risk asset like stocks can be.
When
the upside may only be somewhat limited.
Right. I do not disagree with you, but don't forget, in the VIX, if the VIX moves higher, the calls go with it. So if I'm expecting an increase in volatility, you buy the calls.
Yeah, I'm not privy. Since I've never traded the VIX and don't follow the options, I wouldn't have an opinion of any value there. But I do have an opinion of the actual VIX itself, because obviously it's something I follow for decades.
Yeah, exactly. So just to kind of fill in that little blank there, because you are feeling that the VIX has a fairly good chance.
What did you think of last Wednesday's spike down to 1175? Doesn't that tail on the chart look a little bit like an exhaustion point?
Oh, yeah. Oh, I agree totally. And that's really when I started looking to pick up some calls, which I did.
And that's making me a little concerned that the upside in the S&P may be limited.
Agreed. Again, agreed on both fronts. I do agree with what you're saying. Well, I think that what also happens, and let me just throw this in, and you're more than free to respond to it. I think when we get into a low volume market, which is pretty much what we're seeing for the last several weeks, and actually I can go back further than that, but let's just go back 2 weeks. And then now this is the third week of pretty much low volume. And it doesn't really strike me as a strong enough reason to go and get long. So any of the indexes, but that doesn't mean that others aren't. But I just see the low volume, and that in turn, if something negative should come out, I believe it can nosedive very quickly, because you're going to have the people that are already long not adding to the positions. And if they see any hint of a reason to dump, I believe that they'll come in hand over fist, and we could see these markets drop very quickly. Now, absent of news that would create that type of a scenario, and again, that would include a truly negative earnings report from any of our major players, who were expecting to show better earnings. That could be that negative news that, tips the market, just tips it right over. And then once it gets going, it becomes like a domino effect. It just triggers the next, triggers the next, and triggers the next. And so then we get what we've seen many times, and that's just like a seriously heavy down day as traders and investors attempt to balance what they're doing. Now, some of the reasons that I actually think higher again are, I think that the earnings reports will support it and start to come out. But now I'd like to just kind of go back around, and let's just finish question number 4 here, Jim, and then I want to go into that discussion that you had suggested that I agree with, that we'll start to look at some of the individual sectors. But the first, let's go saying, what is your best piece of advice for trade management?
Well, trade management, probably the best, shall we say, opinion, or my best opinion and observation on it would be around, how much money you're working with, what your bankroll is, and how much money of your bankroll you're going to risk on any one trade. Now, the other thing is anything you can do to create some parameter on the risk, I don't think is a negative either. So, using options in connection with an underlying position, either using puts or calls or something, or replacing a long position or a short position with an option at some point, where you go from having say you had a $50 gain in a stock, and taking that gain off the table and then putting an option on that's only going for $5, which hedges the fact that the market could continue higher on you, but it limits your risk to $5 if the thing falls apart. Good case in point would be Boeing, goes up to 446. Say you bought it at 300 in December, you're up 150 points. You get out of the Boeing at $150 gain, as an example, theoretical. And then if you take $5 and throw the call on Boeing, you still have the 100 shares. For every 100 shares, you still got the right to buy in case it keeps going. But if it goes down like it does now, you don't lose 50 points a year gain. You only lose the call premium, and then you can always buy the stock back down here in the 360, 380 area, wherever it's trading. And obviously, that's another way to use options. So what I suggest about using for risk control, obviously stop loss, but if the market goes fast, they don't help so much. But, stop loss is one way. Again, controlling how much of your bankroll you're risking on any one trade. Obviously, that's very important. And then, of course, if you can use options to replace trades, and therefore limiting the risk that you have after you have been correct on something, is a couple of different ways that I would be trying to control the risk as much as you can.
Very well said. Thank you very much. I, again, echoing what we've already heard, but as a day trader, I feel that when we're into types of markets that we're in, and what would be the best advice for trade management as a day trader, first would be to honor your stop. I think so many make mistakes going like, well, I don't want to get stopped out. I know it's going to go my way. And it's like, well, in today's market, we actually don't. So I don't want people to feel that they're going to know more than the market, because the market usually will win in that case. So I always honor my stop. Does not mean that I can't re-enter in the exact same direction I just got stopped out in, but it's giving me that time to reevaluate what just happened. And it may just be to re-enter on the short side. So I try to use and honor my stops. The other that I would recommend, or advice that I would say, is to really control and manage your position sizing and what you're willing to accept. So you might have a target that, if the market was trending, for example, your target likely would get hit. But when the market is not necessarily trending, say, for example, today, it's more sideways than anything else, you kind of have to shift your strategy and go, well, I'm not going to make the 10, 20, 30, or $40 in the Dow or even in the NASDAQ, but I might be able to make 6, 7, 8, or $10, and which is still a sizable move in these individual indexes. Those are the two that I would really adhere to. Again, as Jim said, you got to pay attention to your money in terms of what's the size of your account. And so you want to get into a practice of never over risking what you have in terms of losing a large portion of it, being pushed into a margin call, if you're carrying positions overnight. So I think paying attention to your capital and what you have at risk in the market. You're going to want to keep an eye on how much of that capital you actually have at risk at any given time.
Another thing that could be helpful for people when they're trying to figure out areas for stop losses or how to figure out different things is using the high and low of the day, then the high and low of the week, then the high and low of the month, and then use the 50-day moving average and the 200-day average, and then try to come up with prices that make sense in order to put parameters around where you're thinking. Obviously, markets making new highs on a daily, weekly, monthly basis, that's obviously something that's significant. If it's doing the reverse, that's significant. If the 50-day and the 200-day are under the price and rising, that's a good thing. If they're, like right now, we've got a lot of them that are still inverted to the downside, not on the S&P index. It's actually inverted to the upside again. But a stock like Apple is still got, I think, a 184 50-day and 191 on a 200-day. Yes, it's trading above both, but it's going to have to stay up here for those things to turn back up. And if we get any news on Apple that would take us back under 191, 184, then obviously that stock is back in the soup. But it does give you some idea on where you'd like the market to stay above in order to get those averages to turn up.
I agree with that.
And obviously, if you're short-term trading, you're obviously going to be looking at more of the short-term highs and lows. If you're in intermediate trading, the weeklies would probably be more appropriate. And if you're doing longer-term trading, the monthlies are very important.
Right. Very well stated. I just want to toss this out because I just saw this come across the news, and it's a Bitcoin trader and his girlfriend are on the run, and if caught, may face a death penalty over their sea home in Thailand. So somebody's in trouble with Bitcoins. Not a surprise. Okay, since we basically it's just Jim and myself today, we thought we might want to just take a quick review of some of the supporting evidence that we glean from the markets to help us look at that larger picture, even a day picture or a weekly picture. And Jim, I'm going to let you start, and you just tell me which other index you're going to take a look at or sector that you want to take a look at. And
well, I did want to make a note that I've noticed that the consumer staples seem to be getting quite the bid, which might also add to the idea that the market is changing, meaning people are going to have a much smaller universe of stocks that they're interested in, and the stocks that have top line growth and earnings growth are going to attract capital. A good example of that today is Kimberly-Clark. Kimberly-Clark today is up over 6%, and it is up $7-8 a share. And obviously, that's not the most exciting, company like a tech company, but it's showing that money is flowing in there. I also noticed Colgate-Palmolive and Procter & Gamble seem to be doing pretty good. So maybe people are becoming a little bit more conservative in some of their stuff, and that's an interesting sidebar to where we are in this market right now.
Right. Did Kimberly-Clark report, or they haven't yet?
Yeah, they reported, and I'm sure they had top line growth, and I'm sure they had earnings growth, and that's why people are in there. But it was also going up in advance of that, and so is Colgate-Palmolive and Procter & Gamble.
Right.
with regard a couple of we could also talk about different stocks that are out there and just our opinion and our observation.
Okay.
uh, One of the companies that are kind of came out um, was Lyft, and I was listening to a value person who was pretty sharp on valuation, and the stock was trading 70, 80, and he was saying that the valuation based on his calculations was more like 58, 59, and that stock right now is trading at 58 or 59.
Right.
This gentleman also said that on Levi Strauss, he thought valuation might be warranted up to 29, and that was when the stock was at like 22, and it's hanging around 23. So there are some people who think Levi Strauss may have a little bit more because it's an iconic brand, and when you get into China and places like that, the iconic brands like Starbucks, McDonald's, you know what I mean,
Hmm.
things that people have heard of, I guess, can be um, a little bit more popular. So there's a couple of different ones there. Do you have any opinion on, do you think, that Apple is going to be able to sustain itself up here and get much above the 210, 220 area, or do you think it could run into some problems here?
I think it could run into some problems here, and that is actually not saying anything on what my feeling on Apple is, because I am an Apple convert. I mean, I truly believe in the products that they produce, and I run all of my trading stuff on Apple computers. I have an iPhone, I have an iPad, et cetera, et cetera. So I still believe very much in the company. But what I think really comes into play here, and again, I think that you're well witness to this yourself, Jim, is that Apple, of course, is the largest retail stock. And what we're meaning is that Apple is, as retail investors, Apple is where they're going. And they go because historically it has proven to be the provider of large sums of money. Now, we have witnessed Apple from October of last year peak out above 230 and then die and just drop $90 down to 140. And now it
Well, of
has,
course, that was combining the announcement that they're not going to give you the iPhone sales, which is supposedly 60% of their revenue, and
right.
they're going to try to kind of show that they've got growth in all these different things. They came out with that announcement that the iPhone was going to do all these different things, and but no specifics and no timetables, and
Yeah.
so some people are a little bit worried that without timetables and without evidence, it's hard to justify some things. But I think
True.
this announcement. I think are they announcing this week, right?
Yes, they're announcing on the 24th, I believe.
Yeah, I think people will be going through things with a fine tooth comb on that.
No, excuse
Popping
me.
around.
Apple comes out on the 30th, so that's next week.
Okay. One that comes out this week that I've been kind of watching is Chipotle. Do you
Really?
watch Chipotle at all? Well, the
I
stock is
do.
not. Yeah, it's gone through the roof.
Yeah, it is. Oh, wow, my God, certainly is. So they certainly have gotten over the bad news. Um,
Hmm.
Again, I think when I see a stock like Chipotle up above 700, I really have to think it's just so overvalued. But then I have to always go back, and you might be able to answer this one, as to what is the total float, because I think that they withhold a lot of shares, which makes it difficult. Or maybe they had a buyback. I'm not sure. But from February, this thing gapped $50 and has not looked back. I mean, it's had some down days, but basically has not looked back. It followed the market through the small correction that we did last week. It did the same. And now it's just heading back above 700.
Yeah, my feeling on it, I tell you, I've been following it very closely. It's very firm, okay, but it's got earnings coming out on Wednesday, and the thing that has me attracted to it is that the 200-day average is at 516. It was around 505 last week, so we're the better part of 40% above the 200-day average. And I don't care what the company is. When you get into that environment,
Yeah.
I'm very interested in the concept of a drop, and I'll tell you why. I'll give you some examples. When we were at 446 on Boeing, the moving average was around 360 on the 200-day.
Mm-hmm.
And the next thing you knew, there was a crash and the stock was trading 360. So, that can happen. Also with what's his face? Amazon. It was at 2050 and the moving
Yeah.
average was at 1500.
And
And
where
then
did it go?
all of a sudden, not only did it go back to 1500, it went down to 1300, right?
Yeah. Yeah.
So,
Oh,
I think it would be very interesting as a abject speculation gamble to see if, in fact, there is some kind of a correction ahead on Chipotle, because again, the valuation is quite high. So when they announce on Wednesday, if there's ever any hint of sobriety into their obviously punch bowl, I think that there could be vulnerability to it, because again, my experience is when I see a 40%, 30%, 50% jump over the 200-day average,
yeah.
uh, that there is a possibility there. And again, obviously, if you're doing put activity up here, you're going against the tape. That's dangerous. You're going against a lot of strength in the market on this thing. That's dangerous.
Yeah.
But the high was made on April 9th. And so the longer it stays under 721, the more evidence that it could stand in there. And there is a year ago, to give you an idea, a year ago, April 24th, 18, stock was trading at 329.
Yes.
And the PE ratio, I believe, is in excess of 100 to 1.
Okay, but if we're and just for those who are listening to us today and are here with us today, I am going to give 100% credit to Jim. Uh, Not that I didn't know, but bringing to my attention, and these are from the studies that Jim does, that 200-day moving average and the percentage it gets above or below where the market is actually trading.
Well, I mean, even on the S&P went to 2350 when the S&P 200-day average was at 2750. That's 400 points underneath the average, and so this
Yeah,
is a big index. And when you get 15% underneath the moving average on a huge index like the S&P,
right.
that's an extended point. And what happened is, boom, we
It
snapped back.
came up.
Yeah.
Yeah,
Because
yeah. I
obviously,
never knew it.
the theory would be the news only goes so far, and then there's some
Yeah,
news that
yeah.
offsets the penalty a little bit, right?
Well, I remember that you and I were actually, we did, I don't remember if it was this show or if it was Analyze Your Trade, but we did a show on the day they dropped it below 2,400.
Mm-hmm.
And you were not a happy man. And not because of the move, but because of how they did it. And, but I think that what's more valuable is, I'm just going to speculate that on that particular day, folks, Jim was discussing with me and others that were here the fact that how they dropped it down, so they went down and they triggered the stops below, dropping it all the way down, and then just started to buy it. And I believe it was on what Jim was just pointing out. So if you're a big enough trader, you probably can go in and force that type of a move. It went down, it dropped, it got too far away from that 200-day moving average, which was way above. So what's the next logical thing? It's going to go back up. And boy, did they come in and they bought it. And they bought
Well,
it hard.
because again, it's a buying and selling environment. So obviously, if Tom, Dick, Harry, and his entire family is selling, they're going to drop the bid as far as they can, and they know that the volume is not unending. So if they see the volume is enormous on one side or the other, they just move the price down or up, depending if
Yeah,
it's buying or selling volume.
yeah,
And then the market maker knows very well that after all this buying volume or selling volume dries out, the market will go the other way under its own weight.
right.
And I don't know if that's happening with Chipotle, because it does have an 8.5% short interest, but I'm sure it was much higher than that before. So you've had a lot of buying coming in, short
Yeah,
covering and also spec. And the guy on the other side of the trade raised the offer to try to take as much of the volume in as possible.
right.
And then, of course, at some point, I'll give you, for instance, the 50-day moving average on the volume is 665,000 shares a day, and the 200-day volume is 721. So on a 50-day basis versus the 200-day basis, the volume is shrinking. Also, today's volume is 227 million shares. So there seems to be obviously a lot of people waiting to see what Wednesday will bring.
Right.
But if I was a guessing man, I would say that the probabilities are that we are extended And if it goes up another 50 or $100, it's not going to be less extended. So, whatever story I have as an opinion and an observation won't become less so with another $100 up. It doesn't become less. Doesn't become less overbought if it goes up another 50 or 100.
And in all honesty, going back to Chipotle, in all honesty, it could move $100. Easily, in either direction. Either direction, folks.
That's why it is a speculation, and I don't know if it would make sense to play both sides. You'd have to price out the options, but
well, that's what I was going to ask you. Would you begin not necessarily look at the Aprils, but maybe May, maybe even June, but May? Would you want to go because
I think they get pretty fat. I think they get pretty fat.
They're really fat. You have to go down. That was what I was going to fill in because you're right. They're really fat. You have to go down to like the 570s.
Yeah.
To get.
But again, with the right news, with the right news and the 200-day average down here at
right.
At the 50-day average is 650. So a $50 move to the downside, but again, it's a very, very, like I say, it's been supported up here in the 700 range, and so I don't know if that means it's extremely bullish or if it's a situation where people are waiting for somebody to light the fuse. And of course, earnings coming out Wednesday would certainly be where the fuse could happen.
I have to tell you, I like that. Somebody waiting to light the fuse. And we're not sure what direction, because it could be one of those, SpaceX capsules that they light the fuse and it turns around and crashes into the ground.
Right. But buying an option is a gamble any way you slice it. And in this particular case, probabilities, in my view, because of it being so extended, lends the idea that it could have a drop. But again, it has been able to hang around up here. There's no tremendous pattern that you could cite to make you think it is going to drop. So again, it might be thin evidence to just use the 200-day as the only evidence. It's just, I've seen, in other words, I would watch this stock, and if I got a decent pattern that said it might roll over, I'd probably respect it.
Yeah, got it. I think that's good, because the only thing I would say is, again, depending on the size of your account and how deep your pockets could be, if you're a speculator and you just want to go in and spec and just say, this is ridiculous, I don't think Chipotle could support this price, blah, 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 whatever your reason is, you might just want to go and go out to May and take a look, or you can go to April, because then you're going to you'll get your move. No, excuse me, there is no April going into May, because April's gone. There's one weekly left in April.
You have end of month. That's obviously a gamble because it has such little time on it. But if somebody was gambling and totally specking, obviously if something surprises on Wednesday, those end of months would probably get some volatility put in them.
Yeah. Anything else that we want to?
Well, everybody, including me, have been kind of positive on the oils, because it is one of the sectors that seems to be rising, and it is a sector that today is getting more price action to the upside, and some of the stocks have had a pullback already. Sean was doing great for a while, almost a 4% dividend, and it went from 90 to 110. So that's a pretty big move for a big company. It's pulled back. Then there was a situation where there was a buying of Apache Oil, not Apache, Anadarko, and so that was something as well. But some of the other companies, people like to see. What do you call it? Exxon. They're going for a lot of the bigger ones during this move. ConocoPhillips is on the radar of a lot of people. It's up 2%, and if it gets above 70, it could be interesting. And again, a lot of these new
ExxonMobil on the daily. I just pulled up the chart. ExxonMobil on the daily. My 200 days at 79. It's trading at 83, and it's up substantially today. It's up about 2.5%. And the thing with crude oil right now, and also with Brent crude, is it Trump administration coming through and ending the waivers on the Iranian oil, which again puts, on the basis that Saudi Arabia and its conglomerate are going to be able to fill that void and release a lot more crude stockpile, getting rid of crude and putting it in there. Now, that's why crude is up over $1. That's why crude, sells off, but then they're all coming right back in. I am seeing commercial buying in crude. So we're getting a little bit of everything. And then, of course, now we're watching the individual oil companies prosper. And
then another sector that people are kind of looking at here is in the financials, because they've had a nice big snapback. The only thing people would probably be a little bit concerned about is, have they come back a little too far too fast, because some of the valuations of the banks have now gone back up. And so, some people are not thinking they're looking particularly cheap. It's hard to figure out, if interest rates are low, then the bank has a hard time making money with the spread difference between loaning and paying on deposits.
Right.
So, I think one of the big keys out there right now is, what's this 10-year yield going to do? Because, a few weeks back at 235, it looked like it was going to collapse down again, and now it's rallied back up towards 260. I think this 260 to 280 range is key. If it can't get through 260 to 280, then this lower interest rate thing that people are talking about may have some weight. But if we get through 260, 280, and these economic numbers start coming in, and the stock market gets going, I don't think low unemployment, high budget deficits, wages that are increasing is going to allow the inflationary numbers to stay as low as the whole world thinks it's going to be. And if there's a inflation surprise, that's going to be a situation where these yields could pop again. And again, everyone's now thinking the Fed is never going to raise again. And only 90 days ago, they were saying they were going to go 3 times. So 90 days ago, they're saying 3 times. Now they're saying never rise again. So, I've been looking at a monthly on the 10-year Treasury and using a long-term moving average. And that long-term moving average on my monthly on the 10-year Treasury is still pointing down, which means if prices are going to drop, then yields will go back up again. And that'll surprise people again.
Yeah.
And of course, that may help the banks if rates went higher, because then there'd be more juice between deposits and loans.
So you're looking at that the 10-year note could go back to 126, 128?
No, I'm saying that the 10-year note is going to go back in the toilet if, in fact, this 260, 280 gets taken out. Where the yield is 258 today. Almost.
I see what you're saying. Sorry, I get it.
So the yield is bumping up against resistance at 260. Then there's some resistance of significance at 280. So if it can get through 260 and 280, then the chart that I'm looking at, which is the monthly graph going back a long time, which shows a downtrending price in the 10-year, which means a rising yield environment, and it's a moving average. It's a long-term moving average that doesn't bend all the time. Then I would suggest that people are going to be surprised again.
Right, and
they're surprising.
I absolutely agree with what you just said. I absolutely agree. Now,
because nobody's looking for higher yields now. The whole world is out there saying the Fed's never going to hike again, it seems like, and yields are going to be dropping, and longer for lower, lower for longer is back in the vernacular. Right. Nobody is thinking that this Fed is ever going to hike again, because
that's exactly whatever. And that's usually when it'll happen. Now, to add to that, going over to the technical side, because that's how I view it, those that have kind of listened to me several times, either in these shows or just in my own work, one of my core positions has been short the 30-year. And I had, when it got down to 136, I was beginning to look for a bounce. I thought, it's really reached a level where it should probably hold for a while and then bounce back. I thought it could go to 152. It got 150. So I'm thinking, and now
on the 30-year, if you start getting the yield back above 3 and back above 310, then the 30-year is back on the bicycle, and the bond prices should drop if we
Agreed.
can. We're right at 299. So, like I say, we're knocking on the door here on
Agreed.
resistance. If
Yeah.
we break the resistance, then the 30-year yield is going to start rising. And listen, with $22 trillion debt, and with the reserve currency, because you can't let the currency turn into the yen or the yuan, or else you won't be the
Right.
you won't be the
Right.
reserve
They
currency.
better start paying more. Right.
Yeah, they can't let the currency tank. I mean, it may go down into if it breaks 95 on the dollar index, you could go down to 90 or 85, but it can't go
Right.
crazy on the downside, or else people, obviously you can't use it as reserve currency.
Right.
So,
I agree. And
uh,
and I think that, so just to finish what I was saying, that I lifted my hedges. So my hedges were in place for that up move. Now that it's breaking back towards 146, I've
yeah,
lifted my hedges,
right.
and which gives me open door for this thing to really begin to slide. And the pattern, I mean, if it was to turn and jump a buck or more tomorrow, that would turn my pattern around again. But I don't see it. And I'm going to stand in agreement with what you're saying, Jim, that we need to look at the actual rate or the implied rate. Right now at these levels, it's 322. And you're right. We're going to watch and see how that goes. And if it starts to signal, traders or other investors who are listening to us, that's what you need to look at. Because the big boys, that's what they're going to play off of. And when they see that go, they will come in and react in the bond. So, but we got to keep our eye on the actual rate. One last chance. We're just going to do just between me and you, kind of like,
Yeah,
again, who you are.
sure.
We've given some great trade suggestions, Jim. So thank you so much for your contribution.
Well,
On that
I'm not giving any trade suggestions because I don't know who's listening. So obviously, it's inappropriate to give a trade recommendation to people you never met. So that's not what's happening. But I did give you some opinions here, and obviously, my observations and my opinions are my own. But definitely, today you did get some feedback on a whole bunch of different things that are going on right now, and I think there's value to that. What I did want to do is invite people, if they have an opportunity, to go to optionprofessor.com and click on the link that allows them to go to the weekly podcast, where I have time to go over a wide variety of information on both the stock market and also on what interest rates are doing, also what gold and the dollar's doing, and international, because we didn't get a chance to touch on China. And there's a lot going on in emerging markets in China as well. So you got a great opportunity to check in with me once a week by simply going to optionprofessor.com, clicking on the link that gets you the podcast each week. And also, what I suggest people to do is, you have situations going on in your life and things going on in your positions and in all that stuff. If you have a question on anything that either you are owning or don't own or thinking about, shoot an email to simply option professor professor @gmail.com, and give your contact information, and I'll be able to speak to you directly and give you some of my view and my opinion on what might be confusing to you, or maybe just to get an outside opinion on what something you're looking at is. So again, go to the podcast by going to optionprofessor.com, and then shoot an email on any question and take advantage of a resource. And Michael, thanks for moderating here today, and I'll throw it back to you right now.
Thank you. I dropped out and came back real quick because suddenly it just said that the connection broke. First of all, thank you, Jim. Thank you, David. Again, on the same basis, if someone has a question and they want to send a question to me, either about day trading, about the futures markets, or about the algorithms that we use and that we will be making available, please just send that to michael@logicalsignals.com, and it'll get to me. I will answer all questions. The website, again, is really under reconstruction, so you can go and check it out, but it's going to be looking a lot different very shortly. And that's going to about wrap it up. I think that we did really well today and filled our time. So, David, I'm going to turn it back over to you, and thank you very much for bringing me in to moderate.
Yeah, thanks, guys. Great show. So just a quick reminder for everyone, be sure to go to TimingResearch.com to get the the report or the recording of this or any of the past shows. And be sure to join us tomorrow for Analyze Your Trade. That will be at the new time of 4 p.m. Eastern Time. And Jim will be back for that one, as well as AJ Brown and Matt Buckley. And just want to thank my guests again for this episode. Neil Batho and Mark Sachs were supposed to be here, but weren't able to join us today, so we'll try to have them back soon. And Jim Kenney of OptionProfessor.com and Michael Filighera of LogicalSignals.com. Thanks, everyone.
Thank you.